Assalamualaikum. Today we will discuss question 5, part B. Question 5, December 2018, FIN 658. Yeah. Okay. Let me read the question first. You are interested in buying the shares of Gamudi Corporation due to good market sentiment on construction industry. You have obtained the partial financial statement for the year ended 2018 of the company and have determined the followings. The total value of common shareholders or stockholders at 50 cents par value is 1,600,000. Then earnings available to common stockholders. Okay, here I believe there's a typo there in the question. It should be 648,000. So there's one zero missing there. So the if you look at the answer scheme, the question meant to the earnings or net income is 648,000, not 64,800, based on the answer scheme. Okay, so to change the question, 648,000. Okay, and then the total assets is 3.5 million, total liabilities is 900,000, and then preferred stock at 8%. So when it says 8%, it means that the 8% is the dividend rate for the preferred stock. So the value of preferred stock is 600,000, and the expected rate of earnings is 30% per year for the next 5 years. Okay, and the dividend payout ratio is 20%, and the cost of equity. Okay, we sometimes call the cost of equity as our required rate of return. Required rate of return or cost of equity is 14%. Calculate the book value per share and earnings per share for Gamudi Corporation. Determine the intrinsic value using residual income model. Would you buy the share if the market price at that time is 5 ringgit and justify? Okay, I have sent the answer scheme to you. So this video should be watched together with the answer scheme that I have sent to everyone through WhatsApp. Okay, so we will go through. So the first page of the answer scheme is the answer, but we have to go through line by line or row by row to understand how we come up with all these figures. Okay, so we will discuss line by line. Okay, so the first line or the first row is earnings per share. Okay, do keep in mind our ultimate goal is to come up, our ultimate aim or goal is to come up with the intrinsic value of the stock and compare it against the market price. If the intrinsic value of the stock is lower than the market price, so the stock is overvalued. If the intrinsic value of the stock is higher than the market price, the stock is undervalued. Okay, we go to the first row or the first line, earnings per share. The formula for earnings per share, okay. The formula for earnings per share is net income over number of shares outstanding. Sorry, net income, or it's called earnings available to shareholders. Okay, here, if you compare this answer scheme against some answer schemes from other semesters, yeah, I don't deduct net income. I don't deduct the dividend of preferred stocks. The reason why, because the statement here says that earnings available for common stockholders. See, the question says that earnings available for common stockholders 648,000. So in my understanding, it means that dividend for preferred stockholders have already been paid. That is the reason why I do not deduct the net income. I don't deduct the preferred stock dividend, because this statement here, earnings available for common stockholders, it means that the dividends for preferred stocks have already been paid. Okay, that is my reasoning. It differs from we will look we will look at other questions, and we will compare against this question. Okay, so to get the earnings per share is net income over number of shares. Okay, so you turn to page 2. You turn to page 2 of the answer scheme. Okay, you turn to page 2 of the answer scheme, in which we have to calculate net income for each year, starting from 2018 to 2023. So in 2018, you are given that net income of 648,000. So that is obvious, and you divide it by 3,200,000 of number of shares or number of stocks outstanding. Okay, let me explain to you how do we come up with this 3.2 million or 3,200,000 number of shares outstanding. Okay, here in the question says that the total value of common shareholders at 50 cents par is 1,600,000. You know, to get this 1,600,000, you multiply number of shares multiplied by the par value. So number of shares multiplied by the par value, you get the value of shareholders, which is 1,600,000. So to get the number of shares, you divide 1,600,000 divided by the par value of the stock, which is 50 cents. So 1,600,000 divided by 50 cents, you get 3,200,000 or 3.2 million. That's how you get a number of shares outstanding of 3.2 million or 3,200,000. And then from 2018 onwards, the net income or the earnings available to shareholders will grow at a constant rate of 30%. So you keep continuing growing the net income figure by 30% every year. So in 2018, you start with 648,000. So the net income will grow at 30% every year until 2023. So here from 648,000, it will grow to, you multiply with 1.3% because of 30% growth, you get 842,400. So earnings per share is 842,400 divided by 3.2 million, you get 0.2633. So for 2020, you take 2019's net income of 840,400, you grow it by another 30%, so you will end up with 1,095,120. And to get the earnings per share, you divide 1,095,120 over 3,200,000, you get 0.3422. And similarly, you keep continuing calculating the net income for 2021, 2022, and 2023. So you grow it by 30% and you divide it by number of shares outstanding of 3.2 million. Okay, that's how you get all the figures in row 1 or in the first line. Okay, so you get earnings per share of 0.2025, 0.2633, 0.3422, 0.4449, and so on, etc. Okay, now next is the next line in your answer scheme is dividend per share. Okay, stated here, dividend payout ratio is 20%. So dividend per share is 20% of earnings per share. So you simply, to get the second row, you multiply 20% of earnings per share for each year. So you get the figures here. The second row figures. Second row figures are 20% of the earnings per share. So you will have these figures: 0.0405 for 2018, 0.0527 for 2019, 0.068 for 2020, 0.0890, and so on, etc. So I hope up to here everybody can follow the discussion. Okay, now we go to the third row or the third line, which is book value per share. Okay, so to get the formula for book value per share is shown here on page 3. Yeah, on page 3 of the answer scheme. Okay, the book value per share is common equity divided by number of shares outstanding. Okay, common equity divided by number of shares outstanding. And how do we get common equity? Okay, so based on the question, you are given the information on the total assets, which is 3.5 million, and then we'll have total liabilities of 900,000, and these figures are given in your question, yeah. So to solve for equity, as we know, the equation of total assets is equal to total liabilities plus equity. So you can easily solve the value. You can easily calculate the equity value by subtracting total assets of 3.5 million minus total liabilities of 900,000. So you get a total equity of 2.6 million or 2,600,000. Okay, so when we say equity, it includes preferred stock and common stock. Okay, so this is the part that I have to explain to you. Equity consists of common stock and preferred stock. So when we are only interested to calculate the common stocks book value per share. So if we are interested to calculate the book value per share of common equity or common equity, so we have to deduct the preferred stock. That is the reason why to calculate the common equity, you deduct equity minus preferred stock. So preferred stock is 2,600,000 from the above. Equity is 2,600,000 and preferred stock is 600,000. How do we know preferred stock is 600,000? It's stated here in the question. Preferred stock of 600,000. Okay, the question is stated preferred stock is 600,000. So you will get a common equity of 2 million. 2.6 million minus 600,000, you get common equity of 2 million. So to get the this common equity value will keep on increasing as the company expands. As the company expands, the net income expands. The company do business. The company makes profit. A portion of the profit will be given out in the form of dividends. The rest will be added into retained earnings, and retained earnings will eventually increase the value of equity, the equity value. That's why that's the reason why we have to calculate the increase in retained earnings. You add back the equity for the previous year. So here, let me give you an example. In 2018, okay, in 2019, okay, in 2019, first we calculate we calculate the increase in retained earning. How do we calculate the increase in retained earning? By subtracting net income, we subtract dividend. Okay, so in 2019, our net income is 842,400. Okay, 842,400. and 842,400, and dividend is 20% of net income. So you deduct with 0.2 multiplied by 842,400, so you get 673,920. Okay, so that would be the increase in retained earning for 2019. So in 2018 we already have a common equity of 2 million. So to get the new shareholders equity, we take 2018's equity of 2 million. You add 673,920. That is an increase in retained earning for 2019. So you get the new value of equity, which is 2,673,920. So to get the book value per share, you divide new equity value of 2,673,920 divided by 3.2 million of number of shares outstanding, you get 0.8356. So you repeat the same process for 2020, 21, 22, and 23. Remember, you must calculate the increase in retained earning. How do we calculate increase in retained earning? Net income of that year minus dividend. So the balance is an increase in retained earning, and you add this increase in retained earning, you add with the previous year's equity value. That's how you calculate the new equity. So you repeat the same process, and then you get the book value per share of 0.6250, 0.8356, 1.1094, 1.4653, 1.9280, and 2.5295. Okay. For the fourth row, you multiply the book value per share that we get from our previous calculation. You multiply with a cost of capital or required rate of return. In this case, the required rate of return is 14%. So you multiply book value per share with 14%. You get the value of 0.1463, 0.1869, and so on, etc. And then this figure you multiply with PVRF 14% N. It means that 14% 1, 40% 2, 14% 3, 40% 4, 40% 5. So this interest factor PVRF 40% 1, 40% 2, that you have to calculate manually, because tables will not be given to you, and the formula to calculate PVRF is 1 over 1 plus I to the power of N. Please refer to the textbook if you do not know what I'm talking about. The PVRF is 1 over 1 plus I to the power of N. Okay, so once you get this figure, the figure of 0.1283, so you multiply 0.1463 multiplied with 0.8772, you get 0.1283, and so on. 0.1869 multiplied by 0.7695, you get 0.1438, and so on, etc. And you add up all this figure, you will get the summation of present value of residual income is 0.8233. Okay, to get the intrinsic value of the stock, you add the summation of residual value income of 0.8233 with the beginning book value. Okay, beginning book value is equal to 0.6250. Beginning book value per share is 0.6250 plus 0.8233, you get 1.45. So this 1.45 is the intrinsic value of the stock. So your decision whether you will buy this stock or not, you compare it against the market price. As I mentioned earlier in this video, you compare the intrinsic value of the stock against its market price. If the intrinsic value of the stock is lower than the market price, the stock is overvalued and we don't recommend to buy, or we don't buy the stock. So in this case, the intrinsic value is 1.45, whereas the price is 5 ringgit. So the stock is overvalued. Since the stock is overvalued, we do not buy the stock. Okay, I hope you understand this explanation, and if you have any question, you are welcome to ask for clarification either through WhatsApp or the easiest way is through WhatsApp. Okay, thank you. Until see you again. Take care. Assalamualaikum warahmatullahi wabarakatuh.